Hi, everyone. This is HDIN Research. Today we are presenting a deep dive analysis into the strategic transformation of ENEOS Holdings. As Japan's energy leader enters its fourth medium-term management plan, the group is shifting from a traditional conglomerate model toward a muscle-oriented structure designed to maximize capital efficiency and navigate the energy transition through 2026 and beyond. We begin with Phase 1, the situation. To understand the current strategy, we must first look at ENEOS's position within the broader macroeconomic and energy landscape of Japan. Currently, ENEOS is the primary architect of Japan's energy security, holding an unmatched 50% share of the domestic fuel market. However, our analysis of the FY 2024 baseline shows a gap between market dominance and capital performance. While operating profits are substantial, the return on equity remains below the double-digit threshold required to satisfy global investors and bridge the valuation discount. The fundamental driver for change is shown here: structural demand erosion. Due to the rapid shift toward electric vehicles and Japan's demographic challenges, domestic gasoline demand is projected to drop to 60% of current levels by 2040. For ENEOS, maintaining the status quo is no longer a viable pathway for value preservation. Moving to Phase 2, the complication. We identify the internal and external frictions that prevent the group from achieving its full valuation potential. We've categorized these complications into three pillars. First, organizational complexity. Managing over 650 subsidiaries dilutes focus. Second, operational volatility. Aging assets have led to unplanned outages. And third, the transition gap. The immense capital required to scale green technologies like hydrogen before they reach commercial maturity. A pivotal complication was the, quote, conglomerate discount. ENEOS addressed this through the strategic deconsolidation of JX Metals. By transitioning JX Metals to an equity method associate through an IPO, ENEOS effectively unlocks hidden value, sharpens its management focus on energy, and creates a significant cash buffer for the next phase of growth. This leads us to Phase 3, the question. Given these structural pressures, what is the optimal roadmap for ENEOS to redefine itself? Management faces three critical questions. How can they re-engineer operations to lower the break-even point? Which assets must be divested to reach a 10% ROE? And finally, how can ENEOS leverage its existing infrastructure to dominate the future Asia-Pacific hydrogen and SAF supply chains? In Phase 4, we examine the answer, the fourth medium-term management plan. This is the group's blueprint for structural re-engineering. The plan sets aggressive quantitative targets for FY 2027. The most significant is the commitment to a 10% ROE and a 6% ROIC. By aligning shareholder returns, targeting a 50% total payout ratio with operational improvements, the group aims to restore market confidence and exceed the cost of capital. The first pillar of the solution is muscle-oriented management. This involves a radical simplification of the corporate structure and the deployment of AI across the value chain. By centralizing FP&A and optimizing the subsidiary portfolio, ENEOS expects to significantly reduce overhead and improve decision-making speed. In the refining segment, the goal is Refinery 2.0. Our data suggests that by leveraging AI for autonomous operations and improving maintenance protocols, ENEOS can push uptime to 90%. This ensures that the core petroleum business remains a resilient cash engine to fund the transition. The second pillar focuses on growth, portfolio reshaping. The group is pivoting from a fossil fuel-centric foundation toward a diversified low-carbon energy mix. We see three clear growth engines: sustainable aviation fuel, SAF, where ENEOS is establishing a domestic production lead; hydrogen, utilizing existing refinery sites as logistics hubs; and renewables, where the integration of VPP technology allows for smarter energy trading and higher margins. This shift is backed by a 1.56 trillion yen investment plan. Notably, a significant management allocation fund of up to 1 trillion yen is reserved. This provides the flexibility to either pursue high-impact M&A or provide additional returns to shareholders, depending on market conditions. Structural change requires cultural change. ENEOS is moving toward a job-based talent management system. By prioritizing digital literacy and leadership succession, the group is ensuring it has the, quote, advanced digital talents necessary to execute an AI-driven strategy. Looking ahead to 2040, the objective is a 50-50 split between base business and decarbonized business. This area chart visualizes the long-term migration of the profit pool toward high-growth, sustainable sectors, aiming for a total operating profit of 900 billion yen. We now reach our final summary. The transformation of ENEOS is a case study in large-scale corporate re-engineering. In conclusion, the new ENEOS is defined by three traits: resilience through operational excellence, agility through portfolio optimization, and a steadfast focus on shareholder value. These elements combined form a robust framework for long-term growth in a carbon-neutral world. Thank you for your attention. This presentation serves as a summary of our findings. If your organization requires in-depth market research, customized industry reports, or strategic consulting regarding the energy sector, please contact our team at HDIN Research via sales@hdinresearch.com.